It is actually 11 o'clock now, so I want
Mhm.
to officially welcome everyone who's joining us today. Thank you so much for taking the time out of your day. My name is Lynn Voss with GoldenCare, and I have the pleasure of introducing Maria from Mutual of Omaha, as well as our special guest speaker, Stephen Alloy. Believe it or not, he has a little over 40 years of experience in the industry. He's been
Yeah, I'm
practicing
old.
law and finance. That's not what that means. Um, he's been practicing law and financial services for those years, and he's moved into the advanced markets with Mutual of Omaha. He's been there for 15 years now, so he's very experienced and really keeps his thumb on the pulse of things like the Secure 2.0 Act, tax advantages that
Mhm.
we're having him on tomorrow for. And I'd like to turn it over. You're seeing his screen now, and we'll get started.
Well, thanks. Thanks very much, Lynn, and thanks for setting this up, and thanks for inviting us too, because it's always
Of
fun
course.
to talk about these topics. And this is kind of a developing topic here, Secure
Mhm.
2.0. It relatively new. It's just passed last couple of days. It was passed and signed into law like December 29th of last year, so still relatively new. Some of the things in there haven't become effective yet, and in fact, the how it relates to long-term care is one of those things that hasn't become effective yet. But I thought we'd talk about it because it has at least one provision that does address long-term care, and there is kind of a debate on, hey, is that going to matter? Is that going to mean anything? Or some people say, well, hey, that's going to be a nice thing. And so let's take a look at it, and maybe we'll see. First, a little bit about Secure 2.0. It's there was a Secure Act. The original Secure Act was passed in December, passed and signed into law. I don't know why they always like to do these right at the end of the year, but December 2019 was the original one. And this has kind of been in the works really ever since then. Finally did get past the end of last year. Most of the original Secure Act and Secure 2.0, which actually has a different name, it's got a longer name, but everyone calls it Secure 2.0 because it's basically an addendum to the first act. Most of it relates to retirement issues, retirement accounts. Does a lot of very positive things for 401ks and other retirement plans. It does have most of it doesn't really relate to long-term care, but one section does, section 334, and you're right, it was up on the screen, but it does read a little bit of it here. Long-term care contracts, purchased with retirement plan distributions. It basically lets people take up to $2,500 per year out of a retirement account and avoid the 10% penalty if they're under 59 and a half, and then they can use that. That has to go for long-term care. So if that they can take up to 2,500 per year and use that to pay premiums on a long-term care contract. Now, some of the you may notice they have some interesting words in here. Oh, and it doesn't become effective until 3 years after the date of the enactment, which would be basically the end of 2025. This will become effective. So not effective yet, but they have some interesting language in here. Say certain specified long-term care insurance contracts, very interesting, has to provide for high quality coverage. Well, I mean, I don't know exactly what they mean by that. High quality coverage is one of those things. I think I'd know it if I saw it, but it's kind of hard to define. So I'm not really sure what they mean, and of course, it isn't effective for 3 more years. So looking at that, I mean, uh, probably what they're talking about with what they say certain specified and high quality coverage is some of these things, that it has to provide meaningful assistance if need home-based or nursing home. Um, that's probably what they're getting at. So it can't be, and I guess this would be a case-by-case basis. Can't be a kind of a trivial benefit that is provided. It has to provide real benefits. Um, hopefully the hopefully the IRS or the Treasury will begin to fill in some of the gaps here with when they come out with the regs on this. But they've as a lot of you know, the Pension Protection Act passed many years ago. I think it was effective starting in 2009, and there was a question about doing a 1035 into a long-term care policy, which is allowed, but the mechanics of it, a lot of carriers wouldn't do it because of the mechanics of it. Is like, well, if you have a lifetime pay, how does that work? IRS said, we'll issue regs on that, and I guess they've been busy because since 2009 they have they have not answered that question. So hopefully they will be a little quicker with this, but I think most of us probably know like quality coverage when we see it. So I think we have a sense of what that is going to be. So some people say, well, a little more on this. Some people say this is going to be a great benefit for long-term care, that once people can do this, and again, this doesn't start until the end of 2025, but once people can do this, it'll be a great way to find the money, because that's always the question is, well, if you're going to pay for long-term care premium, if you can't find it somewhere else, then it's going to come out of lifestyle money, and gosh, nobody wants to do that. So it would be a nice way to find the money. There are some, though, who don't think it's going to be that big a deal, including one of them is Jesse Sloan, who I have a lot of respect for. He's done a lot of great things for the industry. He actually put this on his website, and that's the site where you can see this, LTCi.org citation there. Hate to say it, but it is truly a rather insignificant and meaningless measure in terms of encouraging more Americans to plan for the real prospect of needing long-term care. Few individuals who can afford and health qualify for protection will willingly tap their retirement plan savings for the purchase of long-term care insurance. And for those who do, the tax savings is nominal. In fact, it could actually cost most people more. Again, that's his opinion, and he bases it on some things. But let's look at that, because I get what he's saying, but I'm not sure that I don't know that I'd call it rather insignificant and meaningless. I don't know that it's going to be like the best thing that's ever happened to long-term care, but I don't think I call it insignificant. So let's take a look. He did go on to say that something is better than nothing. At the same website, he said, well, it is something and it's better than nothing, which, okay, I would agree with that. So certain specified long-term care and high quality is likely going to include the traditional standalone long-term care insurance that we're familiar with. Probably would include riders that provide similar benefits. Will hybrid policies be included? That's a question. We don't really know yet whether they would be included, but it might depend on the level of benefit that someone would get out of the hybrid. Again, level of benefits and things like inflation protection are likely to be critical factors. Now, most of the riders, at least our rider, does not have the inflation protection, and most riders probably don't. So, because it's based on the initial death benefit. So that, I don't know what factor that's going to be in whether this would count toward the 2,500, or if the rider would have to be filed separately and not basically the cost for the rider would have to be taken out of separate premium rather than out of cash value, in which case a lot of riders, including ours, would not meet that test because ours is taken out of cash value. So a lot of this we don't really know yet, but hopefully it will become clearer. Might be clearer by then if they are a little quicker than they were with the Pension Protection Act. We may have some answers to this. Certainly, we got almost 3 years to get the answer, so hopefully somewhere in there they can do it. This is what Jesse Sloan was basing his that this is insignificant. He said this is a lot of what he was thinking, is that most buyers of long-term care are over 55 or 60. Now, I guess I'm exceptional. I bought it when I was I was 50, but I wasn't over 55. So, there are some that do. So we're saying for that group, if you're already just about 59 and a half, avoiding that 10% penalty, may not be that might not be a huge motivator, because either you're already 60 and you're avoiding it, or you're 58 and you say, well, so 1 year, all right, no, it's not that big a deal. The withdrawal too, and think of, some people are thinking, hey, there's a free withdrawal. Well, no, it's not totally free. It is going to be a taxable withdrawal, so they should be prepared for that. All it'll do is it will avoid the 10% penalty if you're under 59 and a half. But on the other hand, and we'll talk a little more about this later, it is a ready source of the premium. So if you're talking to somebody that says, hey, I know I need long-term care, I know this plan makes sense, I got to do something, but I can't afford it. Well, this might be a way to find the money. Is that, well, if you can, once this is enforced, I mean, it's not enforced yet, for you won't be able to do this until probably maybe the very end of 2025, or really more likely into 2026. But at that point, maybe this is a great way to find that premium and say, hey, you can take it out. It's going to be taxable, but you'd be paying it with your own after-tax income anyway if you don't do this. So, it's really not that different. So, and you don't have the penalty. So that might help. That might be a good way to maybe get some younger people interested in long-term care. So about 10% of the policies, I guess, according to Jesse's organization, are bought by people 50 to 54. That benefit might be a little bit more. They would sense a better benefit, perhaps. Perhaps that might get more of them to buy long-term care, and that 10% could become a higher percentage that are bought by relatively younger people. I guess that's the big question. We don't really know if avoiding that penalty is going to motivate younger buyers, because I guess I would agree, if you're already 60, it really doesn't matter. But if you're 45 or 50, you look at, even 50, you're looking at almost 10 years of that you would have that penalty. And if you can get 10 years of no penalty and a ready source of the funds, that might motivate some younger people to buy long-term care. So, and Jesse kind of ran through these numbers. He was saying that people won't tap into their retirement funds to pay for long-term care. I'm not so sure about that, because people tap into their retirement funds for all kinds of stuff. And so of 50, as if to prove that, 52% apparently of retirement plan owners have tapped into their retirement savings for one thing or another. And there's percentages, about a quarter of those, and those percentages are of the 52. So about a quarter of the 52% paid off debt. About another fifth of them almost used it for a down payment on a home. Some paid for college and medical expenses, and some just did whatever miscellaneous stuff with it. The point he was making is that long-term care insurance buyers tend to have available assets, and that's largely true. But you think about it, a lot of them have assets, but I don't know if I call it readily available. Maybe a lot of them aren't sitting on cash that they'd want to liquidate, or if they do, if they are going to liquidate something to pay a premium, might they be looking at an ordinary income or a capital gains tax that's going to be worse than the penalty. So I don't know. I'm not so sure that people won't do that. I think given the proper setting, and again, if they're a little younger on the long-term care side, maybe closer to 50 than to 60, I think a lot of them might. I think this might be a motivator for them. And then there's sort of the tax health conundrum. Here's what I call it is. It's penalty free, but it's still taxable, the withdrawal, the $2,500. So, according to Jesse saying, if you're 55 and you're still working, the $2,500 is going to be taxed at your ordinary income tax bracket. So, okay. And they says, well, but if on the other hand, if somebody that would avoid that, if you're 55 and not working, you're maybe not working for health reasons, in which case you'll be declined. You won't get the coverage. So it's sort of a conundrum that those who would do it are more likely to do it, may not get the coverage, and those who will get the coverage might be less likely to do it. I don't know. We'll have to see on that. I can see an argument that a 55-year-old is still working. I mean, if you're going to pay it, if the choice is my 401k or lifestyle money, they're both going to be paid with ultimately after-tax dollars. So I don't know. I don't know that there'd be a huge difference really in doing that. And the additional tax, I mean, I guess counter argument to what Jesse's saying here is if people have available assets, the additional tax on $2,500 more of income shouldn't be a game changer for them. I mean, it shouldn't be a deal killer. I mean, because that'd be about $500-600 for most people. I mean, that shouldn't be a stop the deal at all. If you do have available assets. So I don't know. This I think remains to be seen how that's going to develop. But again, I kind of countering what Jesse's talking about here. Something is better than nothing, and I would agree with that. I mean, this is, at least on the federal level, a lot of states have put in place, and a lot of states are looking at putting in place some pretty decent incentives to buy long-term care. States with state income taxes typically will give a tax credit. Some are looking to expand that tax credit or tax deduction or some sort of benefit to encourage people to do that. So it's good to see this on the federal level. Something is better than nothing. And again, it is a ready source of the premium. If somebody says, hey, I can't afford, whatever it is, $1,500 for long-term care, it's like, well, maybe there's a place you can get it. Maybe, or I can't afford $2,000 for long-term care. Maybe there's a place you can get it. Speaking of states, a lot of the state-based programs, certainly everybody's probably way too familiar with the state of Washington program. And a lot of other states are looking at going the same direction. There are proposals out in multiple states, and a lot of states are kind of in the very early stages of it. So I think what we may see is, interestingly enough, when this becomes effective, the end of 2025, 2026, we could be looking at a lot of states that are now in the very early stages might be further along, might have bills pending. So I think this could hit at a time where people might be looking to get long-term care in place. The reason they would do that is with these state-based programs, you can opt out of the payroll tax. I mean, assuming they use the Washington model, you could opt out of the payroll tax by having long-term care on your own, having private long-term care. And, really for looking at people with higher incomes, getting standalone long-term care is going to cost less than what they'd pay in the payroll tax, and they'd get a whole lot more, right? Because again, if Washington is an example, it's a 0.58%, which doesn't sound like a lot, but think about it. If you're making $200,000, that's almost $1,200. It starts to add up, and at some point you look at that and you say, I could get, well, and just to back up for a second, for that $1,200, whatever, that $200,000 earner in the Washington program would get a lifetime maximum benefit of $36,500. That's lifetime maximum. So, I think the original idea with a lot of these programs was that they would get a year before they get an extra year. Basically, they wouldn't have to pay on Medicaid. I'm not aware of anywhere where you can get a year's worth of care for $36,500 unless you just have somebody coming in a couple hours a week. Maybe you could for that, but any sort of sustained care. So, as these programs are kicking in, the ability to opt out of it might be, I would think, would be really critical particularly for higher income earners. So you combine that with, hey, not only do you want to get long-term care in place so you can opt out of the payroll tax, but you also now you can take the premium out of your 401k without a penalty. So I think that could be a motivator. Put those two together, and they're probably going to hit it right around the same time. Um, and just think, so much of the sale. I mean, we've talked about logical reasons, but so much of any sale is kind of the emotional part. And I mean, I'm sure you've seen this. You probably see this with business owners where if it's their own personal money, they get a little nervous. But if you say, yeah, the business can pay for it, it's like, oh, okay. It's they get a lot more relaxed. It's kind of the same thing when, I think in thinking of, hey, I can either pay for this with lifestyle money, which basically means unless I get a big raise, that basically means I'm going to have to do less of something I'm doing right now. It's kind of a zero sum thing, rather than saying, oh, no, keep doing everything you're doing. Don't worry about a thing, and you can take this out of your 401k. Emotionally, that's going to feel better to a lot of people. So and I wouldn't dismiss that as a motivator. I mean, I think that will be I think there will be a motivator. And again, it's not like, as you all know, it's not like the need for long-term care is going away, because if anything, I mean, the baby boom's kind of in it now, or at least halfway in it. So as the baby boom finishes, there's going to be a lot of need for long-term care. Again, this is longtermcare.gov. 70% of people turning age 65 are going to need some form of care. And maybe it's in-home care a few days a week. Maybe it's, I mean, who knows what it'll be, but they're going to need some form of care during their lifetime. And so, knowing that, and they're thinking, okay, well, I can pay for it this way or this other way, where taking it out of the 401k, it's like, I think once you put those two ideas together too, that might be a motivator as well. And of course, when you're looking at long-term care, as you all know, Mutual of Omaha is really a leader in the long-term care industry. We have, great products, a great history with long-term care, and we have a lot of resources inside the company that can help you, design the right case and really make the case to the client that that this is what they need. This is a good thing for them. So with that, we got a little bit of time. I don't know if people have questions, and Lynn, I don't know if they can, I don't know if unmuting or if they type it in, or I don't know how
So in the past, we used to unmute all, and it kind of turned into chaos.
Yeah,
so what we prefer now, what we prefer now is anybody that does have questions, you can go ahead and type them into the chat. I can read them aloud and have Stephen answer them. So far, it looks like we haven't received too many. I do think you covered it in great detail, even including some of my own questions about the likelihood of this and of course, like you said, it's a developing topic. And I think as we move toward that 2025/2026 date, we'll probably have a lot more of our questions answered. But I think over time, we have an opportunity to, as long-term care insurance professionals, and using things like social media and email and our outreach with our existing client base, just to help spread the awareness. You had mentioned those various state programs, and I've already heard rumors that some of them, considering this type of legislature, they're not going to give that escape hatch. They won't give people time to put long-term care in place. I've heard that when some of these states, in considering this, they're, according to whatever date they intend to launch, the exemptions would only apply to those who already have private long-term care insurance in place. So again, it comes down to everyone spreading awareness. Even if you don't live in Washington, New York, California, some of these other states that are considering a similar type program, it definitely is worth starting the conversation, in my opinion.
Oh yeah, I would agree, Lynn. And a lot of states that you would not think would ever do anything like this are looking at doing exactly something something like Washington did. California we know about, and actually on your comment on the opt out, the exemption, um, the one that kind of stands out, and that always is a wild card. I mean, Washington had the
Mhm.
opt out, and some of the others that have actually introduced bills had the opt out. But there's no guarantee that the state's going to do that. I mean, a state may not have an
Right.
opt out, and even if they do, there was a bill proposed, didn't go anywhere, but it'll probably come back, and hopefully they'll fix this. But there's a bill in New York where it had an opt out, but it basically, the opt out was whatever year the bill passed, you had to have long-term care in place as of January 1st of that year. So think about it. If it passes in December of 23, well, if you didn't have it by it's already too late to opt out.
Right.
So, I mean, hopefully they'll fix that, because that got a lot of, as you can imagine, a lot of negative, a lot of negative comment on that one. So hopefully they'll fix that
Right.
one. But if that comes back, I mean, yeah, there really is no guarantee that they're going to let you opt out.
Yeah, we are getting some questions typed in. One
Hmm.
is a little off topic, but
Hmm.
April submitted a question that asks whether there is any plan for Mutual of Omaha to begin offering a partnership qualified policy in the state of Indiana. Um, Being an advanced sale or advanced market, I'm not sure if this is your forte, but I think you do a little bit on the partnership.
We do a little bit. I mean, as far as the planning, the what's in the works, I'd probably maybe check with either Amanda or Maria.
Okay.
I would check with them, and because I'm not really sure what they have in mind. I think it'd be a good thing, but I don't know.
Yeah, it's always tricky with some of those original partnership states. And in fact, I know the options are few because some of the carriers that were well known for offering those partnership programs,
Mhm.
like John Hancock and Genworth, the industry has changed quite a bit over the
Right.
last several
Oh
years.
yeah.
So
Yeah.
um, I can
Uh,
certainly follow up with, oh,
Yeah, no, I
Maria,
was going to say yes. Hi, Lynn. Hi, Steve.
hi.
Yeah, at this time, we have not heard anything about Indiana. I know that I believe Hawaii was originally one of the original partnership, but they have at this time partnership sales pending. So perhaps
Mhm.
that's a possibility. We have not heard of anything happening to Indiana. Indiana, New York, California, Connecticut, as you know, are still original partnership states.
Right. Okay.
Mhm.
Well, again, it's definitely something we can keep an eye on, April, and I appreciate your
Mhm.
question. Always good. Um, the some of the other questions are revolving around short-term care, and I know this
Mhm.
isn't something that Mutual of Omaha has broached yet, but we
Mhm.
have um, several other, of course, in GoldenCare's portfolio, we work with several companies, some of which do offer short-term care insurance.
Right.
And I believe the questions go along the terms of, whatever impact this may have on the long-term care insurance industry, I believe there may be an equal impact on the short-term care insurance industry, being that the short-term care really just expands some of those options,
Mhm.
going down to say 1 year or a 6-month benefit period, things like that. Some of these short-term care plans include inflation protection,
Mhm.
and just being that they are shorter duration plans, there's less risk on the insurance companies. So where this might draw interest for the long-term care, it should, in my opinion, extend over to the short-term care. Um, Perhaps I shouldn't ask, but I will anyway. Does Mutual of Omaha have any interest in developing a short-term care product?
Again, I might defer to Maria on that. I'm not.
It is a
I have
better
not
question
heard.
for Maria.
Yeah, I have not heard of one, but
I'm
so
Okay.
with you, Steve. We have not heard of any development of a short term.
Okay, and I know that the Mutual Care Solutions products that are currently available, they do go down to 2.08 years, and they are among some of the most flexible plans available. So regardless, you can still build a really flexible and affordable plan anyway. So along those same lines, we had another question submitted that talks about hybrid policies and whether I know that the IUL exist. Well, the two IUL plans exist with the optional long-term care rider. Do you know, is there any plan to develop a true linked benefit policy that resembles more like Nationwide or One America?
You know, I have heard that there is some talk, and we had some years back we did have a hybrid annuity, and
Yeah.
there has been some talk of either bringing that back either as an annuity or as a hybrid life, but I'm not sure where it stands. I don't know if you throw it back to Maria again. I don't know if maybe you've heard something, but I know that that's sort of been on the table for a while because kind of looking at the industry.
Right. That's what I heard as well, Steve. Looking at the interest rates and so forth, but we have not announced anything, and I haven't heard any updates on that as well.
Yeah.
I assume at this point it's just rumor anyway, but we all like to press see what kind of information we can gather from others who are certainly in a position to know.
Well, it's under discussion apparently. It probably very light discussion at this point, but it's it's under discussion.
All those years ago, Stephen, I do remember it was I think it was called the Living Care Annuity.
Living Promise. I think it was Living Promise.
Oh, well, we have Living Promise still. That's the whole.
Well, I think it's give me a second. I remember that product as well, but it did begin with Living. Yes, you're correct.
Yeah, and the only my memory could be faulty too because I'm not pulling up any information to try and base that off of. But we've had some discussion, and I don't want to put it off any longer. We did schedule this for about 45 minutes, and at the end, we were going to draw for some winners of Mutual of Omaha Wild Kingdom swag. So Maria was actually very integral in getting GoldenCare some of those items. And I want to turn first off, I do want to thank you, Stephen, for putting up the Advanced Markets Partners. Anybody who has additional questions on the Secure 2.0, tax advantages, anything like that, Mutual of Omaha has this entire department of advanced market sales experts. They're readily available to help answer your questions. And of course, you can always call GoldenCare at 800-842-7799 to help answer any questions. And of course, if our GoldenCare staff is unable to or don't know the answer right offhand, we too can reach out to these experts at Mutual of Omaha. So I wanted to thank you for sharing that screen, and then I'll turn it back to my screen so that I'm able to share the wheel.
Did that? Okay.
There we go.
Did that work? Okay. All right.
It did. Okay, so we've got our names here.
All right.
It does. I know sometimes technology can create more hurdles than good, but we've got our wheel here. And the very first thing that I want to draw for is not just an individual swag item, but we have a small gift bag of various items. So that will be the first item we will draw for. And the random winner is Walter G.
Hey,
congratulations to that winner. And what I'll do is I'll also draw 2 additional winners, and those will just be winning individual swag items. So things like a tumbler, or we have some very nice bound notebooks. We've got branded pens. There's a coffee mug. There's some very cool things. Let me go ahead and bring up the next one just so I don't lose our first winner. So this winner for an individual swag item is Kevin C.
Hey, congratulations.
Congratulations, Kevin. And like I said, we'll do 2 winners for that individual swag prize. The other winner is James M.
Great. Congratulations to you too. Yeah.
All right. So again, thank you everyone for taking time out of your day today. This was really a good and informative presentation, especially, like I said, it's a developing topic, but it's always good to know what we're headed into. And you've done a fabulous job just giving a little bit of background and your opinion. And, we do like to continue hearing input as things go along. So as we near that 2025/2026 date, we may have you on again for an update. Things are
great.
Likely to change.
Oh yeah. Yeah. We hopefully will have a much clearer picture of it by then.
Yeah.
I hope.
Yeah. Yes, I hope as well. But thank you so much for joining us today, Stephen. Maria, thank you for joining us.
Thank you.
I want to thank all of our agents. Thank you for taking the time out, and I hope everyone enjoys their day.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799.